Capital Income Tax in General Equilibrium, Part 2, Gauss Computer Program, Chapter 5, word for tau k.g. Hello and welcome back to our second part of our video tutorial on the welfare effects of capital income taxation. So in the first part we looked at the economics of a capital income tax rate, the material that is presented in Chapter 5.4 in my book Public Economics. And we find tremendous welfare effects amounting to a couple of $1,000s per American citizen from abolishing capital income taxes and replacing it with a labor income tax. Now in this tutorial we will look at the computation. So we will use the Gauss computer code, Chapter 5, word for tau k.g, which I would like you to download from my homepage. Please also download the slides for my book from my homepage on Chapter 5 for a description of the model. And we will use the computer program to solve a nonlinear equations problems, which is essentially the steady state for the economy with and without capital income taxes. Next, we will also do an exercise which is not contained in my book, Public Economics. So we will, rather than increasing labor income taxes to replace the old capital income tax, we look at the case where we can use a lump sum tax. And there we will compute extremely high welfare effects. So if we abolish capital income taxes and replace it with a lump sum tax, then we get welfare effects that amount to more than $12,000 per each and every American every year. So let me get into the economics to refresh what we did in the first part. Just take a brief look. Let us take a brief look into the model. So therefore, I would like you to download my slide for the book Public Economics, Chapter 5, Income Taxation. Let's get into the chapter on capital income taxes and just refresh what we learned about the model. So households maximize intertemporal utility, and therefore they discount instantaneous utility per period utility U with the factor beta. Instantaneous utility is a function of consumption C and leisure 1 minus L, and the weights attached to these two arguments are iota and 1 minus iota in the Cobb-Douglas function. The budget constraint is given in equation 15, and we distinguish two cases. The one where depreciation is tax deductible, that's case 1, and the one where interest income RTKT is taxed at rate tau k, and depreciation delta times k is not tax deductible. We have shown that these imply the first order condition 16, which are the first order conditions with respect to consumption CT, labor LT, and next period capital KT plus 1. And in the Euler equation, equation 16c, we have to distinguish the cases where depreciation is tax deductible or not, cases 1 and 2. The production side is standard, so we have a Cobb-Douglas technology production function, and wages and interest rates are equal to the marginal products of labor and capital respectively, so we assume that goods and factor markets are characterized by perfect competition. The government budget is balanced, so total government consumption G is financed by labor income taxes tau LWL and taxes on capital income tau k R times k, and in case 1 we also allow tax deductibility of depreciation delta times k. So this results in steady state in the 6 equations 20a through 20f. The Euler equation, the first order condition with respect to labor, wages equal to the marginal product of labor, interest rate R is equal to the marginal product of capital, the resource constraint, and government consumption G is equal to revenue, so we have a balanced government budget. Now let me show you the model which we use to compute this equilibrium, this steady state. Therefore, I would like you to load your Gauss, open your Gauss program, load chapter 5 well4tau_k.g into your editor. There are two versions of this program on my homepage. One is for more recent versions of Gauss, so it has the suffix Gauss 19, and the other one is without. The more recent versions of Gauss just use new commands, graphics commands, and I will apply this version here. I use Gauss 19.1, so therefore I use the program chapter 5 well4tau_k Gauss 19.g. So first thing you do is to see if this program works, and therefore I would like you to also download the toolbox.src into the same directory. In this toolbox we have saved the nonlinear equation solver, so this has the name fixvmn1, which solves nonlinear equation problems. So you provide a procedure with the functions. In our case, this will be the 6 steady-state equations and an initial value x0, and it returns to you the solution of this problem. So therefore you need to store toolbox.src in the same directory, and this is included here in the beginning of the program so that Gauss knows where to look for this procedure. So let's run the program, Control R, and the program works fine. You should see the display of the solution, and let's get back from the graphics to the editor. Now the Gauss computer program is structured as follows. In line 20 you can specify whether you would like to look at the case where depreciation is tax deductible or not. So we look at the case where taxes are imposed on interest income and there are no deductions for depreciation. In the first part we calibrate the model. So we set the production elasticity of capital alpha equal to 36%, the discount factor beta equal to 0.96, implying a real interest rate after depreciation of approximately 4%. Depreciation delta is set equal to 10%. The inverse of the intertemporal elasticity of substitution, sigma, is set equal to 2. Labor supply in the benchmark equilibrium in the initial steady state is set equal to 0.3, and the labor and capital income taxes are set equal to 23 and 41%, the historic averages over the last 50-60 years in the United States. In case that capital depreciation is not deductible, we can compute the real interest rate R star from line 35 from the Euler equation with the help of our calibration of beta, delta and tau k. With the help of the steady state condition that the marginal product of capital is equal to the interest rate, we can compute KL, capital labor ratio, which we store as variable K star, assign the variable name KL star. And with our calibration that labor is equal to 0.3 in steady state, we can compute K star, the steady state capital stock. With K and L, of course, we can compute the wage rate W and production Y. We add the name star to W and Y to denote steady state values. Next, we compute government consumption in steady state in the benchmark equilibrium, which are tax revenues tau L, WL plus tau K R K. And our government share is displayed on the screen. So therefore switch into the command window and just move up to the place where this number can be found. So we have a government share of 29.5%. This is a little high. So in the United States, the government consumption is approximately 18% of GDP. So we are a little bit off here. With the help of the resource constraint, the steady state resource constraint, we can compute consumption as a residual from output production minus government consumption minus depreciation. So notice that in steady state, investment is simply equal to total depreciation. So we just replace the depreciated capital stock. With the help of the first order condition on labor, we can compute the variable, the parameter iota, the weight on consumption in utility. Here in this program, I have named it GAM. And you can see our initialization, calibration of this parameter is equal to 0.3256. That's the weight of consumption in our Cobb-Douglas utility. Leisure has the weight of 0.67. And now next we test our procedure steady state, where we compute the steady state variables for endogenous variables L, C, K, W, R, and tau L for given value tau K. So let us skip down to the steady state procedure. Here in the steady state procedure, we have the 6 endogenous variables: labor, consumption, capital, wages, interest rate, and labor income taxes tau L. We have the 6 steady state conditions, which you just saw in the slides. The first order condition with respect to labor, the resource constraint, the interest rate, which is equal to the marginal product of capital, the wage rate, which is equal to the marginal product of labor, and in case we depreciation equal to 0, so where capital depreciation is not tax deductible, the Euler equation as presented in equation 5, and the fiscal budget as presented in equation 6. So what we do now is next we analyze the effects of a capital income tax rate tau K by changing this value down to 0 and beyond, and compute the value of the endogenous variables: labor, consumption, capital, wage, interest rate, and tau L. Therefore, we have to solve this nonlinear equation problems in 6 equations and 6 endogenous variables for different values of tau K, and we use a grid between 70% and down to minus 10%. So tau grid specifies the exogenous capital income taxes for which we would like to compute the solution to our steady state variables. And this is done in the loop, in the iteration in lines 76 through 89. So we supply a new value of our capital income tax rate, compute the solution to our nonlinear equation system with the help of the command fix vmn1, which computes the solution to the procedure to the function stored in steady state, and store the value in the matrix solution, and display this solution in our figure. Now this figure, perhaps you have the same figure as I do. The display is not really nice, so you have to change the display here by switching to a scale of 100% in your editor. And now your graphics look like this. So sorry for this nuisance, but this is unfortunately necessary since our display of the new graphics in Gauss 19 is is programmed for the case that the display is 100% the scale. So you can see that with decreasing capital income taxes from 70% down to minus 10%, labor income taxes increase, and they move up from 23% in the benchmark to more than 37 to 80% at the case for zero capital income taxes. As a consequence of higher labor income taxes, we reduce our labor supply. And because of lower capital income taxes, we increase our capital, our savings, and see the tremendous increase of capital. So from the benchmark case with 41%, we increase capital from 0.6 to 1.2, 1.3 in the case of zero capital income taxes. So therefore savings almost doubles, while labor supply only decreases by less than 10%. So as a consequence that capital stock doubles while labor supply only declines by a little less than 10%, our production increases with lower capital income taxes and higher labor income taxes. As a consequence, we can increase consumption, but only up to a certain maximum value, which is around a capital income tax rate of about 5%. For this value, consumption decreases again, and the reason is, well, from our still increasing production, we have to spend more and more on replacing the depreciated capital stock. Therefore, we have less production left for consumption. So as labor declines, leisure goes up. This increases our utility, but as consumption starts to decline again, utility declines again, and the effect on instantaneous steady-state utility is graphed in the lower left panel of this figure. In the remaining part of this video, we will study an alternative problem. So far, we have assumed that the shortfall in capital income taxes is paid for by labor income taxes. Now we look at lump sum taxes instead. So I would like you to ask to download my solution manuals for the book Public Economics from my homepage. Let me get into this material here. It should look like this. And it's work in progress, so right now it only provides the answers to some selected problems of my book. So, for example, we move to problem 5.11, which I added to this manual. So you will not find it in the book. This is just for your advantage here, for those of you who like to dig a little deeper and to follow this video. So we consider the economy with the labor and capital income tax as described in section 5.41, the one we just studied. Government consumption will be held constant, so we assume that G is equal to 0.111, just like in the benchmark economy, with a labor income tax of 23% and a capital income tax rate of 41%. Now we set the capital income tax rate equal to 0 and keep the labor income tax rate at the level 23% and finance the shortfall in government revenues by a lump sum tax. And you are asked to compute the steady-state effects. First, what are the changes in the steady-state equations 5.18 from the book? And you are asked to compute the consumption equivalent change that's resulting from this fiscal policy. So let us first look at the effects on the fiscal budget. The fiscal budget is now given by revenues tau LWL, the labor income taxes, plus the lump sum tax T. And they have to finance government expenditure G from the old steady state. The household budget constraint also changes, so we do not have to pay capital income taxes anymore. So we get RTKT, the interest income without any deductions, but we have to pay lump sum taxes TT. The first order conditions are provided by equation 515. First one is the one with respect to consumption, unchanged. The second one with respect to labor, also unchanged. But our Euler equation 5.15c changes, so tau k is equal to 0. In steady state, we now have 5 equations, 516a through e. The Euler equation is changed, and besides, all other equations are the same, and we can drop the fiscal budget. It just serves to compute the lump sum taxes T as a residual. So now we have a nonlinear equation system in 5 equations, and the 5 endogenous variables are interest rate R, wage rate W, capital stock K, labor L, and consumption C. And the new equilibrium is computed in the program problem P511 new.gss, which you can also download from my homepage. And it computes the solution to this nonlinear equation system 516 after we had set the capital income tax rate tau k equal to 0. So let's go back into our Gauss computer program. So what changes do we need to implement in chapter 5 for tau k.g in order to compute this new equilibrium with lump sum transfers? Well, we just copy the calibration, which is carried out in the first 55 lines. The steady state we just computed and find out, well, it's fine. And next, we just delete the remaining part of the main program because we will not use it anymore. So we do not compute the solution for different tax rates on capital income tau k, which are balanced by a labor income tax rate, but we can just erase it and save the resulting file as problem P511 new.gss. Next, we notice that we have to supply a new endogenous equation system for the steady state. So therefore, we just copy the old one, steady state, copy it, and rename it as the procedure with a new name, steady state new, for example. This is now an endogenous system in 5 equations, and the only thing we have to adjust is our Euler equation here, where we set tau k equal to 0. The other 4 equilibrium conditions in the steady state are unchanged, and we have to delete the endogenous variable tau L because now we set tau L equal to 23% and keep it constant. Notice that we have not inserted a new variable for the lump sum tax T because we can just compute it as a residual. And next we supply a new initial value to solve this system, steady state new, and the name for this initial value is x0. We supply, well, of course, the old steady state variables. Values for the labor supply L star, for consumption C star, for capital K star, for the wage rate W star, and for the interest rate R star. The nonlinear equation solver fix VMN1 computes the solution to this system, so we have to provide as arguments the initial value, our guess, and the procedure, of course, preceded by the @ sign for our procedure. And it returns the solution in the vector xf. We store the solution xf in the new labor supply, LU, the new consumption, C new, and further below also in the new capital stock, K new. We can then compute the new production, Y new, from the production function and report percentage changes for labor, consumption, output, and capital. we can also compute the consumption equivalent chain. Therefore, we submit C star and L star as arguments to the function utility, util. So in the procedure util, here in line 109, we compute the utility, instantaneous utility from consuming C and leisure 1 minus L. And line 81 specifies the consumption equivalent change that is associated with the new policy with a lump sum tax that replaces capital income taxes. So let's run this program. And here you see our results. So labor increases by 2.9%, consumption by 32.9%, output by 38.4%, and the capital stock increases by 135%, so more than doubles. The welfare effect that is associated with this new policy is a consumption increase of 29.5%. Now, to put this into perspective, let me get back to the solution manuals. There you also find this interpretation of our welfare effects. So first I downloaded a series for US total consumption expenditures. You find this data at the Federal Reserve Bank of St. Louis, the database FRED, and it's freely available. You just press the link that is provided in my solution manuals. And I find that total consumption amounts to approximately 40 billion in the US in 2018. So in per capita terms, if I assume that we have about 320 million people in the US, this amounts to $43,750 per person. 29% of this is equal to $12,884 per person. So this gives you an idea about the magnitude that's involved with going from a capital income tax, setting it to zero and replacing it by a lump sum tax. It would result in a welfare increase that's equivalent to $12,800 per person each and every year. The lump sum tax that is associated with this policy amounts to $5,382. And this is, of course, the problem why this is not implemented. Some people are too poor to pay these kind of taxes. And we would probably end up like Margaret Thatcher and observe riots in the street and have to withdraw our policy if we implemented it. Let me also issue a second warning here at this point of time. We have completely neglected transition dynamics, so we only looked at the steady state. And here, consumption increases, leisure improves, and we have savings that increase by more than 130%. Now we neglect to look at the transition. And during the transition, of course, we have to build up this higher capital stock. Therefore, we have to increase our savings which are equal to our investment far beyond the depreciation of the capital stock. Otherwise, we would not be able to build it up. And therefore, our consumption is smaller during the transition. And our utility, as a consequence, is also much smaller. So therefore, if we wanted to give a fair evaluation, should the government today get rid of capital income taxes, we should also compute the transition dynamics and would find, of course, that the capital income tax rate should be higher in this case. So, for example, I do such an analysis with Hans-Peter Grüner, and we look at the case where we use labor income tax rates to finance the shortfall in capital income tax rate, and there we find that also accounting for the transition dynamics, the optimal capital income tax rate is as high as 9%. But Of course, it's much, much lower than the present capital income tax that you find today. So let me summarize the main finding of these two videos on the general equilibrium effects of capital income taxes on output, employment, consumption, and welfare. In general equilibrium, the capital income tax rate is extremely distorting. Savings are reduced to a very high percentage, and welfare effects from moving to a zero capital income tax rate, to abolish capital income tax rates, and financing the shortfalls with the help of labor income taxes results in tremendous welfare effects. So, for example, if capital depreciation is tax deductible, then we have something like 4% of total consumption as our welfare effect, or this is something like about $1,000 for each and every American every year. And the welfare effects are considerably higher if depreciation is not tax deductible. Now, I would like to advise you to play around a little bit with this computer program and perhaps try to compute the transition dynamics for the simple general equilibrium model that I presented to you, and I hope you enjoyed the tutorial.